All right, well, let's get the market conversation going. Our first guest on the show this morning is Fook Hien, Senior Investment Strategist at Standard Chartered Bank. Fook, great to have you with us on the show. Happy Friday to you. So what do you make of, the market setup here in India? Let me start with your view on the home market here, because it's had a dream run. It's digested all the election-related volatility. And now bank stocks in India have finally started performing. Though, of course, the overall index itself is at an all-time high. Do you think the Indian market is good for more, or do you expect some consolidation?
No, we do like it over the 12-month outlook. I mean, within Asia, I got to say, India is our preferred market at the moment. As you said, the election news has been well digested. We're really looking for the earnings growth to be driving the market. We think that's going to be continuing, and it's positive. So, I mean, India is our preferred market at the moment. Look, in the short term, when markets make all-time highs, it's natural to assume some consolidation. But we've looked at it in the past, particularly in the US, when the market makes all-time highs, more often than not, the next 6 and 12 months average and median returns are actually positive. So it's nothing to be fearful about. When market makes all-time highs, the momentum tends to continue. And India, as I said, is our preferred market in Asia at the moment, driven by solid earnings growth we expect to continue.
Okay, so India is your preferred market in the Asia setup, driven by solid earnings growth. Got that. But do you think that India can replicate the kind of gains that it saw last year? Because, it seems like now we're settling into some sort of consolidatory phase. There's not too many cues. I mean, the market already has sort of priced in the government coming into power for the third time. There is, of course, a budget, but not too many people are expecting any major changes this time around. So your thoughts on whether we can replicate the gains that we saw in the last 1 year?
Yeah, look, I mean, I'm not going to quantify it. I mean, our view is that India can outperform. But if you look at the earnings growth, if you're looking at mid-teens growth, right, if your multiples and your valuations stay the same, the earnings growth is just going to drive the market higher. And we're looking at a mid-teens kind of earnings growth. So even if valuation stays there, and we think that globally, we're not so worried about valuation now, given that we've moved into a rate cutting cycle. With more major central banks cutting rates. And as that happens, we get less worried about valuation because we think it can sustain. So even if valuation stays the same, the earnings growth will propel it. And I say mid-teens kind of earnings growth is very positive for India. Markets like US as well is another one that we do like for the same reason. Not so worried about valuation, but because of the earnings growth that's going to be driving the returns.
Right. I remember you speaking about a barbell approach to investing in India, which is on the one hand, you look at industrials and cyclicals. On the other, you look at defensives and then deploy money in the large caps itself. How has that strategy evolved over the last couple of months? And what are you looking at now?
Yeah, that's right. Thanks for that. I mean, we are still looking at a barbell view. I think on the more cyclical side, we still like industrial. We think the expansion in terms of the capacity will continue. We do like discretionary as well, consumer discretionary, and this to tie with the very long-term trend of the improving income for the for the market in India, and that's going to be helping the consumer discretionary. And then on the barbell side, being more defensive, we have healthcare. So these are our three preferred sectors within India. From a size or style kind of perspective, we do like large caps, given that they have a bit more of a buffer and a bit more solid. So we do prefer large caps within India.
Yeah, large caps haven't run up as much as the smaller stocks. So let's see if that trade plays out. Fook, what's the risk to your overall call, positive on India, positive on the US? What is the biggest risk?
Yeah, no, thanks for that. I think the risk really is inflation does not come down as we expect. We think there are signs that it's been coming down, and the last two prints in this US CPI have been coming down. We're going to watch the PCE next week. But we expect that to be on a downward trajectory, which really paves the way for the major central banks to be lowering interest rates. So that's one. And the second one really is the traditional indicators of a recession, like your inverted yield curve is still there. The leading economic indicators, things like the job openings data in the US, that's been softening a little bit. There is something that we are watching very, very closely. we still have about a 20% probability that we still get a recession. That is something that we have to watch out for because the risks are there. Like I said, the traditional indicators for the yield curve, it is still there, although it's been there for some time, but something that we continue to watch.
Okay, Fook, thanks a lot for joining in. Appreciate your time here on CNBC-TV18. That's the word coming in from Standard Chartered Bank. They say India is their preferred emerging market within the basket. And they also talk about how they're not too worried about valuations at the moment globally because they believe earnings are picking up across the board and nothing to be fearful about despite the market being at record highs.